we'll be at 13,000 on gold. That's my calculation at this point. There's a small part of me that still thinks gold could go down to 3,500. That was kind of my worst case scenario. With gold, what did gold do? When gold got through its line, it like ripped higher. You have all these other assets. I mean, semis are starting to rally. The stock market's at all-time highs. Gold is going. Bitcoin, who wants to be in Bitcoin at this point? Like, no one. So near term, I am bullish. I still think there are massive issues out there that are starting to become worse. Mainly, we saw retail sales this morning coming in at minus 0.6 versus a consensus estimate of 0.1%. So the consumer is suffering. We're seeing the jobs data.
You do this with the 10-year yield. Something happened, Gareth, on the 31st of July. Now, I know the yen intervention happened.
You get a Federal Reserve Fed Watch tool telling us that now there is a 70% chance that there is no rate hike in September. Imagine if the stock market here fell 44% in a month. That would panic everyone. And then you look at stocks like SanDisk, you look at Micron, they all bottomed out.
Let's move on to gold now. Like I mentioned in the beginning, gold spiked at the same time that the S&P did. Right now, though, is momentum strong enough that you would be looking at another retrace towards $5,000 an ounce?
So I think gold is going much, much higher. It's just a matter of the time. So number one, great wedge pattern. Look at how when it broke out, it was a awesome breakout. Now, I do think you are going to get a retrace here. We're probably going to come back towards 4,000, maybe even 3,900. But at this point, once you get the breakout, you buy the pullbacks. This downtrend has been broken. All right, that's number one. We're starting to get slightly higher lows and now slightly higher highs. And so, again, the breakout is there. I do have it penciled out based on a calculator and calculations that I've done is that by 2029, 2031, we'll be at 13,000 on gold. That's my calculation at this point. So I think, listen, there's a small part of me that still thinks gold could go down to 3,500. That was kind of my worst case scenario where I'd be like buying with both hands, physical metal, etc. It only got down to 3,900. But at this point, you know, you see the writing on the wall. Like we've talked about it in this interview, all the negatives that are ultimately a positive for gold, even silver, and so on and so forth.
You know what's interesting, and I'll come back to gold in just a minute, but you know what's interesting is that we talked about the gold price popping. We talked about S&P popping around the end of July. Bitcoin's still flat. In fact, it's down today.
Yeah.
In fact, gold's up and Bitcoin's down today. Yeah, Bitcoin,
If gold can rally while Bitcoin stalls, the market may be revealing where defensive capital wants to hide. Gareth Soloway notes that gold's breakout was dramatically stronger than Bitcoin's, but the bigger signal is the divergence itself. Investors are rewarding tangible monetary protection, while speculative assets struggle for follow-through. A pullback toward $4,000 could become accumulation rather than failure. Next, Gareth Soloway reveals why the next gold retracement could expose who is buying weakness.
Just whatever moved the markets, by the markets I mean the stock market, whatever moved the stock market at the end of July, whatever moved gold, that force did not have any impact on Bitcoin whatsoever. It's still flat.
Yeah, and what we're seeing is, so number one, we actually did get a breakout on Bitcoin, and it's probably one of the weakest breakouts I've ever seen in my life, because you can see this trend line goes to the from the all-time high down to this pivot. We hit it, then we hit it again 3 times here, and we finally got through the line. Now with gold, what did gold do? When gold got through its line, it like ripped higher. Bitcoin just petered out, and as long as it stays above this white line, there's actually a bullish angle to this, meaning probability actually favors upside here in the near term on Bitcoin. But I think what's going on here is that you have all these other assets. I mean, semis are starting to rally. The stock market's at all-time highs. Gold is going. Bitcoin, who wants to be in Bitcoin at this point? Like, no one. I mean, even Michael Saylor's had to sell like $100 million to cover and buy other things and cover dividends. The one thing, again, I will say, I'm short-term bullish on Bitcoin, and I think also the Clarity Act issue. So you had the Congress punt the Clarity Act to the next session. That just happened days ago when they went on break. Now they're not coming back till September, so I would think that probably late August you start to see an uptick here.
Bitcoin broke its trend line, yet gold exploded through resistance while stocks climbed, creating a divergence most headlines barely acknowledge. According to Gareth Soloway, Bitcoin's breakout remains technically bullish above support, but capital is rotating towards semiconductors, equities, and precious metals instead. For investors, chasing Bitcoin may carry opportunity cost risk, even if prices rise. Next, Gareth Soloway exposes the late August catalyst that could determine whether Bitcoin catches up or falls further behind.
So near term, I am bullish. I still think there are massive issues out there that are starting to become worse. Mainly, we saw retail sales this morning coming in at minus 0.6 versus a consensus estimate of 0.1%. So the consumer is suffering. We're seeing the jobs data getting weaker and weaker per the last number. And we're still seeing inflation while it's kind of in line with expectations. We're still at a 3.4% inflation rate per the headline numbers. So yes, the charts are saying higher, that we're likely headed. I have a target of around 81 to 8,200 on the S&P by year end. But I think, again, this is the final throes before something much worse is on the horizon that's going to hit probably in early 2027.
Let me just pull up a chart real quick, and then I'll let you share yours. So I'm going to show the S&P 500. Let me actually just show the SPX here. So the SPX, and this is, I'll just overlay this with gold, but you could do this with a lot of different things.
The strongest markets can hide the weakest economic foundation. Bitcoin is holding technical support, yet gold has shown far greater follow-through, while consumer and labor data deteriorate underneath record equity prices. Gareth Soloway's argument suggests investors are confusing rising asset prices with improving economic health, even as inflation remains elevated. That divergence matters, because portfolios can look healthy immediately before the underlying economy turns. Next, Gareth Soloway exposes the macro fault line beneath the rally, and why early 2027 could punish complacency.
You could do this with the 10-year yield. Something happened, Gareth, on the 31st of July.
Yep.
Now, I know the yen intervention happened, and perhaps that was the trigger, because that may have signaled that the government was willing to stop the interest rate from going up further by preventing a sell-off of U.S. treasuries if the yen carry trade unwinds. But was there something else? Because on that day, the end of July, risk assets moved up together. And so if it was just a few stocks reporting good earnings, you could make it a earnings argument. But this seemed to be a macro narrative here.
Yeah, I think it was a combination, right? I think what you saw here is very clearly the economic data has weakened. We talked about retail sales, the jobs report, inflation numbers are becoming, again, I don't want to call them low because they're not low and it's ridiculous, but at least they're not continuing to spike. So you throw that into the pot and stir it around, and what do you get? You get a Federal Reserve Fed watch tool telling us that now there is a 70% chance that there is no rate hike in September. If you go back to July 29th when the markets were bottoming out, there was a very high probability, in fact, over 70% chance that the Fed was going to hike in that next meeting. And so that's been the change. Interestingly enough, the Kospi, which had fallen dramatically, and let me jump into the charts here because I think this is really fascinating to take a look at. But if we look at the Kospi here, it actually bottomed out right on that same point right here. And that was a big correction. I mean, that was scaring a lot of people. We had a drawdown in the Kospi, which is the South Korean stock market, of 44%.
July 31st may matter less for what markets bought than for what suddenly became unnecessary to fear. This is where Gareth Soloway's thesis shifts. Weakening data rapidly changed rate expectations, with the probability of a September hike reportedly falling from above 70% toward no hike. That is not a small technical adjustment. It changes the valuation engine for risk assets. Investors should watch policy expectations, not headlines, because easier money pricing can lift markets while economic stress deepens. Next, Gareth Soloway reveals what changed underneath that one-day reversal.
Imagine if the stock market here fell 44% in a month. That would panic everyone. And then you look at stocks like SanDisk, you look at Micron, they all bottomed out right there as well. And so there was a combination of macro data, which then changed the odds of rate hikes to rate stationary play, and potentially I honestly think that we'll get cuts in 2027. That means risk on because it's cheaper money. It doesn't have to worry about the higher rates. And that means, again, Kospi, semiconductors, you name it, it all goes back to rallying.
What right now is overbought for you?
So overbought, there are some plays. I mean, individual stocks, for instance, MongoDB, MDB. Again, this isn't going to be something that's macro related, but if you look at this chart, incredible surge just since July 24th when it was under 300, is now approaching $500. Major trend line right up here. So these are the types of things. I also think there's a bigger dynamic going on with the US dollar. You brought up the dollar yen just a little while ago, but look at the US dollar breaking here. And we know the stock market likes a weak dollar. Multinationals make more money when they convert those other currencies back to dollar if the dollar is dropping. And then the 10-year yield and the 30-year yield, which still remain at ridiculously high levels, at least they're not pushing up, right? So if we go to the 10-year yield here, and we take a look, you can see it's really flatlined ever since, interestingly enough. I mean, you could really go back to May, the high pivot in May. We've just been stalling around here, and that's giving investors a little bit more confidence that, essentially we're seeing a slowdown. And I think we can't overlook, and sorry to ramble here, but we can't overlook the oil price as well. Oil again was popping up as missiles were flying and strikes were going on, and all of a sudden, basically, the president has said we're going to do economic sanctions on Iran, but we're not going back to missiles and attacks. And what does that mean?
A 44% monthly collapse in a major stock index is not normal volatility. It is a warning about how quickly liquidity can disappear. According to Gareth Soloway, the subsequent stabilization reflects changing rate expectations, weaker dollar pressure, and yields that stopped climbing. But cheaper money can inflate asset prices without repairing the economy underneath them, especially when oil and geopolitical risk remain elevated. Next, Gareth Soloway exposes why the dollar, treasury yields, and oil may be the missing pieces behind this rally's durability.
It means the midterms are getting pretty darn close, so we can't be having a war and continual casualties going into midterm elections.
Are you saying that the government is going to make sure, through whatever means necessary, that the markets remain elevated into November?
I would say it's not the government per se, but I think that people that are in charge of the government, I think the president, we know President Trump looks at the markets as a gauge of how the economy's doing and also looks at it as popularity and votes to some extent. And therefore, yes, I do think he will do whatever it takes to keep the markets at or close to all-time highs into November. Now, after that, that's where things could get a little bit choppy. And listen, we also are going to watch the Federal Reserve. We'll have to watch inflation. But I would say that until the midterms, there will be no more major strikes on Iran until after the midterms. Then we'll have to see where that all pans out.
Okay. Right now, are you expecting the Federal Reserve to raise interest rates further?
No, I don't. And I didn't even, believe it or not, ever since Kevin Warsh was put into the chairmanship, I have been steadfast on this. And I've even said, I think we can go back to our past interviews. I said he will not raise interest rates. And two factors there. Number one, I actually believe President Trump when he said he would never appoint someone that was going to raise rates. And number two is, while Kevin Warsh in his last press conference talked this great game, we're going to get, prices under control, we're going to do this, and we've even had hawkish members of the Fed come out and be super hawkish and talk about raising rates, there's been very little detail. Like it's a lot of hardcore talk, but there's nothing backing it up, and that's telling me everything I need to know.
The real risk is not a market crash before November. It is a market that stays artificially calm until investors stop questioning why. What Gareth Soloway notes is that political incentives may favor avoiding major disruptions into the midterms, while the Fed's rhetoric remains more hawkish than its actual policy path. That creates a dangerous comfort zone for portfolios. Prices can stay elevated while underlying risks accumulate. Next, Gareth Soloway exposes why the Fed's tough language may matter less than what policymakers actually do.
And now, miraculously, we're seeing all the pieces of the puzzle fall in. Labor markets weakening, retail sales, which tells you the consumer's hurting. We see oil prices staying somewhat elevated, but not at their highs, so it's not really pushing inflation up. Everything's falling into place, including the supposed CPI and PPI numbers, which came in this week and were basically muted, in line, or slightly better than expected. It takes all the pressure off, and thus the Fed watch tool is now telling us that.
I think it takes, I'm just looking this up, 4 Fed governors How many to make a decision on a rate hike or cut? So
Yep.
I think the point is Kevin Warsh is just one member. Yes, he's the chair, but the committee itself votes as a whole. So
Correct.
if the majority want a rate hike, it unfortunately doesn't really matter so much. If Kevin Warsh wants the other the other way to happen, am I right there?
You are absolutely right, but I would not overestimate the influence that can be put on other members of the Federal Reserve. Now, listen, there's going to be a few that won't be influenced, and we've seen that in, I think, last one there were multiple Fed governors that wanted to hike rates, but there is always going to be someone who can be swayed, especially when the data is starting to weaken. I mean, think about it. If you're one of those four governors that votes for a hike and you raise rates, and then all of a sudden the jobs data collapses, think about the pressure. So the easy out, as human beings, we like to generally take the easy out, is to say, oh, well, at least if we're wrong, it gets blamed on Kevin Warsh. But if Kevin Warsh doesn't want to raise rates and you're one of the people that pushes it, then it's falling on your head. And people just don't want that pressure. And so I think that some will, and I think they want some. I mean, think about it like this. The Federal Reserve is going to want people to say, hey, we want to raise rates, and even some vote for it because it keeps the independent look of the Fed.
A weakening labor market can become bullish for markets when investors start pricing the rescue before the economy needs it. According to Gareth Soloway, softer employment, consumer weakness, and contained inflation are reducing pressure on policymakers, while individual Fed officials may face political and institutional pressure when deciding how to vote. That creates a peculiar setup. The economy weakens, but asset prices rise because investors anticipate easier policy. Next, Gareth Soloway unravels how Fed voting dynamics could quietly force the next policy pivot.
It keeps the hawkishness on there, and so it keeps control of the situation. But ultimately, what is the outcome? I guess we'll find out. But I say no rate hikes the rest of the year, and I say cuts in 2027.
Wow. That's a pretty bold prediction. Cuts because the labor market is going to deteriorate or inflation is going to return to normal.
I think inflation is going to stick in this 3 to 4% range, and then ultimately the labor market is going to continue to weaken here, and we will see essentially a mini stagflationary scenario in 2027, and that's really where I worry about the stock market. I think through the midterms, probably fine, maybe 2%, 3% drawdowns, which is just normal, but then pushes to all-time highs. I think we hit 81, 8,200 by year end. Then starting in 2027, that's where I'm going to get concerned. Now, let me show you this chart here, and this is why I think the 82 to 8,300 level is appropriate to mark on. So number one, here's a chart of the S&P 500, right? So we were in this parallel channel since COVID's low, bull market 2021 highs, and we talked about this in past interviews. Here's your lows of the bear market in 2022 and 2023. Here's your tariff sell-off down to that same trend line. We then went to the high end, but look, we broke out. So we broke out of the channel, and then all of a sudden a resistance level, remember it was resistance here and resistance back here, it now became support. And so this is kind of my level in the sand, if you will. As long as we stay above here, it remains bullish, and it held, and we've gone higher. Now, if we continue up, there's one thing that is paralleling here.
The uncomfortable possibility is that the next bullish market phase could be built on deteriorating economic conditions. What Gareth Soloway's argument suggests is a 2027 combination of 3 to 4% inflation and weakening employment, creating a mini stagflation scenario, even as the S&P potentially reaches 8,100 to 8,200. For investors, that means a headline gains could conceal worsening purchasing power risk. Next, Gareth Soloway reveals why the S&P's apparent breakout may actually be approaching a historical valuation ceiling.
We take a trend line right from here, right? So these levels, and essentially we bring it up to this high point here. Okay, and I'm going to change the color on that so it pops out for all you guys that are watching. If you look at that, that's the logical next parallel to get hit. And where is it? It's right around 8,200, 8,100. Now, you might say, okay, well, it's a parallel, no big deal. I want to show you another chart that's even wilder here. So let's get rid of these drawings. Let's do the S&P divided by M2 money supply. Now, the reason why M2 is so important is that M2 is how much money's in the system, essentially. So in theory, the more money in the system, the more money that's being created, the higher the stock market can go because some of it always finds its way in. So if we go to US M2, so let's divide SPX by US M2, and we bring up this chart, I want to show you this. If we go to our weekly chart and we go back to the .com high right here. So here's your .com bubble high. Here's your low from 1982. Here's your collapse, financial repression or recession, the big financial crisis low. So you're connecting two pivots, and guess where this would go? How much higher it would go if we hit 8,200 on the S&P? We would top out on the M2 money supply factoring when looking at the S&P. And I hope I explained that clearly enough, but that would essentially mean that we are more expensive in terms of M2 than at the .com, but it would be essentially the high of the parallel channel or resistance. So the two factors, the S&P level there and the S&P divided by M2 money supply, right there at 8,200, I think that's where we're headed, and that's where we could see that next big drawdown.
The most dangerous market top is the one investors can justify with abundant liquidity. This is where Gareth Soloway's thesis shifts. An S&P target around 8,100 to 8,200 would collide with a major resistance zone when measured against M2 money supply, potentially recreating the valuation extremes that preceded historic drawdowns. That matters because monetary expansion can disguise how expensive equities have become relative to available liquidity.